Uh, I think that events like elections and budget can just create a lot of hype in the market and can make markets digress from the normal path for a short period of time. Once all these events have played out, ultimately it's back to fundamentals. Now, in the case of India, unlike many other countries, you have a domestic economy and you have an export economy. So, at any given point of time, one part of the corporate world will be doing better. Like you can see it in today's time where the domestic economy for the last 3 years is not doing well, and exporters continue to go from strength to strength. Investing should not be, based on events. It should be based on properly on goals over a period of time. And in India's case, where you have enough opportunities in the market, investors should just treat that elections as a noise. And in equities, investing is all about doing through SIP and knowing their goals in the mind. Okay, we've continued on that and we continue with that philosophy where all of us sit together and decide on the sectoral calls. The sectoral calls have not changed, unfortunately, for the last 9 months. We continue to be overweight IT, continue to be overweight pharma, auto ancillaries, media. We are equal weight on FMCG and underweight on, probably, one thing overweight which I missed out was cement, and underweight on telecom, oil and gas, power. Only the one change, which I missed out was that we went in telecom, we went from overweight to underweight over the last couple of months. So within these weights, different fund managers are having their different options on the stocks which they think. I think we will see heightened volatility this year, much more than what we have seen in the last 1 year. Simple reason being, a regime change is taking underway, where we are going towards inflation targeting if we go as per the new Urjit Patel committee report. In that kind of environment, as RBI tries to bring inflation under control, it will have to fight on all the fronts and probably will lead to a much higher volatility than what we've seen before. If you have a longer term horizon, you should do an SIP in duration funds over the next 6 months. But if it is where you have to park your money for a year or so, short term funds or FMPs are providing a good enough yield. We have a good team over here. I actually was quite fortunate to inherit a good team over here. The one thing which I've been a macro guy actually, and I do not get into the micromanagement of the different fund managers. When we agree on sectoral weights, the sectors, overweight and underweight, that is where I stop, and I look beyond that thing in processes and risk management. So we would have limits for different stocks, we would have limits for different sectors, overweights and underweights. We would have limits for liquidity, illiquidity kind of thing, and that is what I like to spend my time on, looking at these portfolios. Are we digressing away from the mandates a fund manager is supposed to have? And one more thing which I've done after coming over here, now we are much more open and we are meeting distributors, telling them about our strategies, how we are doing in funds, whenever we are doing good and even bad also. And it is, I think, that is a change which I've got. There's nothing much actually to talk about.